Hello, my name is Todd Hutchison, and in this session I want to talk about financial matters for running a business in the real estate industry. Let's face it, the real estate industry can have ups and downs, and since the COVID-19 pandemic, the prices of commercial properties have come dramatically down. Lots of leases available and empty properties, high vacancy rates. And these issues with tenants not being able to operate by the government intervention has caused commercial contracts to be revisited for force majeure clauses, or at least being prepared for future similar scenarios. This said, what a great time to buy. Of course, that's if you're moving in to run your own business, as opposed to the vacancy rates when you're trying to hold it as an investor, which would be a really no-go zone right now. You also have to keep up with legislation changes, such in Western Australia's update of the Strata Titles Act 1985, WA, that required all strata management agreements to meet the minimum requirements of the new Act provisions by the 1st of November 2020. This effectively meant that the strata management company could go from having strong portfolio base, where they've got a lot of secured contracts in place which have a commercial value to be able to sell the business, to almost having zero over those overnight until they went and got them back in place. That could be a danger and a great headache, because sometimes people are going to use it as an opportunity to try and renegotiate their strata. See, complying to legislation, having agent licenses, sales representatives registrations, all this is just a part of doing business in the industry. And we have to choose which industry we want to play, and every industry has its own games and rules. The finance basics that you need is largely the same, independent of the type of business you're actually running. Let's talk about some of the terms you need to know. Well, there's two types of accounting systems in Australia. We have the accrual accounting versus the cash-based accounting. Now, accrual accounting recognises the transaction as it happens. So if I put in a purchase order to buy something, the accounting system decides that that is money spent. And if I send out an invoice for money owed, then that's deemed to have the money transaction is coming in. And that leaves us with things called debtors and creditors. And hopefully it all works out, otherwise your debtors might become bad debtors. So looking at that, that means that the GST gets paid even though the cash may not have been moved. But if you're a small or a startup business, you can't do that because you don't actually have the money. So that's why the Australian Taxation Office also recognises cash-based transactions. So cash-based transactions do not get recognised until the actual money moves. So if I do order something, I don't see it as being paid until I have actually paid it, or when I have received the income. So basically, accrual is transaction-based, where cash-based is cash movement-based. There's also a concept of profit versus cash flow. See, cash flow is king, because you could have a very profitable business, and what is profit? Basically revenue less expenses, and what is left is profit. And in a company scenario, you only get taxed on profit. However, if you don't have the cash flow to pay your debt as and when it's due, then you could find yourself being insolvent. And companies that are profitable can go into insolvency, meaning to close up or administration, because they haven't managed their cash flow. Because of course you have to pay your salaries and wages, and therefore you've got to hold the money in the bank to do so. Now, there are a number of financial statements you must recognise. One's called cash flow projections, and we use that to budget by working out the future cash flows in and often cash flows out. Basically, what do we expect the revenue to be coming in, and what do we expect the outgoings to be, or the expenses? When we're looking at that, that allows us to then to forecast what we're expecting to have and what financial position we're expecting to be realised on a month-to-month basis. This allows us to create an annual budget. However, there are a couple of account systems that we need to use to actually report on our current financial well-being. The first one is the profit and loss statement. Now, the profit and loss statement accounts for all revenue less expenses. And if there's more revenue than expenses, we're effectively in a profit position. If there's more expenses than the revenue coming in, very dangerous position, this is called a loss. And therefore, we couldn't sustain much loss if we didn't have money in the bank or reserves to carry us across. We're always being driven to try and make profit. And remember, we only pay as a company tax when we've made profit. And then there is the balance sheet. The balance sheet allows us to recognize assets such as cash and other assets we may hold, minus liabilities such as loans. Now, if I go assets minus liabilities, that gives us our equity, which basically is the ownership of the business. Now, these financial statements are generally created using accounting software as opposed to just using spreadsheets. It's far better off to use the right tool for the right job. And accounting software sometimes can be plugged into other specialist software for the real estate industry. See, there are many accounting systems out there such as Xero or MyOb or QuickBooks. And as I mentioned, there are third-party applications that bolt on to these applications that are specific to the real estate industry. Also, you can have a desktop version or a cloud-based solution. Of course, a cloud-based solution means you don't have to take care of servers sitting in your workplace, and your computer or device, even your handheld device, can get access to the accounting systems as you go. This means that effectively you're going to be paying some form of monthly fee to have that cloud-based system. But being cloud-based means generally you can access it from all over the place and across many different devices. All accounting packages need this thing called an accounting ledger, which is often referred to as the chart of accounts. It provides names and codes for separate revenue and expenses into separate little accounts that are meaningful to us to be able to track, record, and report. Take, for example, when you're thinking of income categories, there are many different types of revenue accounts. For example, you might have sales revenue, listing revenue, leasing revenue, property management revenue, auctions, interest revenue, and even valuations revenue. Also remember that these largely will be duplicated because we'll usually have a separate set of accounts for residential compared to the separate commercial. Now consider expense categories. They may include commissions, royalties, listing cost of sales expense, and buyer cost of sales expense, as well as general business categories like administration, salaries and wages, payroll tax, insurance, vehicles, building and infrastructure, and even marketing, just to name a few. But you can see that in a budget, you can set up the amount for your marketing. You can make sure you're tracking only to that budget that you've put in for that marketing by tracking your transactions against that marketing account. These chart of accounts will be set up with the help of your accountant. And over time, you can add accounts as and when you require it. And you generally find the happy medium when you know this is the best way to report that's meaningful and useful to the real estate business. Now, each different company or business you have needs separate accounts. So you can't merge two accounts because every legal entity must be operating separately. Of course, if you're running a group of companies, you can get those separate accounts and present them together into what's called a consolidated accounts. And that generally is reflective of a group that has several businesses under it. But that means you will have to control or majorly control or own each of those separate entities that you're reporting to. However, you will notice that they're still separate accounts. They're just being reported together. Also, any financial records need to be kept for a minimum of 7 years under the Australian legislation. And when looking at the cost of doing business, you have to set up a budget for the year. And that is based on that expected revenues, which is the projection of likely revenues, and also expenses. The trick then is to manage your costs to your budget and to drive revenues to meet or exceed what you had projected. Just remember, you have to hold money for key payments that includes things like for insurance, GST, goods and services tax, payroll tax, and other forms of taxes. In fact, some people set up a different bank account just to make sure they're moving money there in preparation for these payments, including superannuation. That means they don't accidentally spend them. It's actually segregated, good business practice. And at the end of the day, it's all about managing your cash flow. Cash flow is king. Remember, if you can't pay your debts as and when they arise, you might find yourself insolvent and not able to trade. This generally means managing your expenses and generating more income.